Have you ever, spent any time scrolling online and seen those truly mesmerizing ads for automated trading robots?
Oh, yeah, they're everywhere. Hard to miss.
They really are. And they promise the dream, right? Total financial freedom, perpetual automated income, and these like jaw-dropping performance charts.
Flawless charts, yeah, where the profit line just goes straight up month after month. Never seems to dip.
Exactly. It looks like the simplest, most risk-free way to, escape the 9 to 5 forever.
It's probably the most powerful sales pitch in the retail trading space.
Hmm.
They aren't really selling software, are they? They're selling this illusion of financial perfection.
Absolutely. And that leads us straight to the central question we've pulled from our source material today. If these systems, specifically the ones built on that really aggressive Grid Martingale strategy, if they work so perfectly, why isn't everyone who buys one already rich?
Right. And maybe more importantly, why are the vendors still selling you a, say, $99 piece of software? Why aren't they just quietly compounding their own money into billions?
That's the real head scratcher.
And that is the core puzzle we're going to try and unlock today. The reason the math just doesn't add up for the seller is because behind those really polished charts, well, there's a dangerous kind of dirty secret.
Okay.
So our deep dive today is all about exposing that secret. We're going to unpack the three key truths about risk and, frankly, statistical manipulation that vendors of these systems really, really don't want you to know.
Okay, let's get right into it then. Starting with the number one marketing trick, showing you just one specific metric while deliberately, hiding the one that actually matters. We're talking about the huge misleading gap between balance and equity.
This is absolutely fundamental. If you don't grasp this difference, you're basically buying into the lie from the start. So let's talk balance first.
Okay.
Balance shows the account value based only on closed trades. And here's the kicker. The Grid Martingale strategy is explicitly designed to never, ever close a trade at a loss. It just holds them open until they can be closed and profit.
Meaning the system itself is sort of genetically engineered to make sure that balance chart looks amazing. It only ever gets injections of profit.
Precisely. Yeah, because it only records closed profits. The balance curve logically just seems to rise constantly, smoothly. It creates that utterly irresistible illusion of a perfect, flawless system.
But like you said, that's not the real value of the account, is it?
No, not at all. The true measure is equity.
Right. So tell us, what does equity actually include?
Equity is the real total value of your account right now, and that includes all the currently open losing positions. So while that balance curve might be shooting for the moon, the equity curve is telling a, frankly, terrifyingly different story because it includes all those floating losses.
And the source material we looked at calls these massive sharp drops or dips, right?
Yes, exactly. The equity curve usually tries to shadow the balance, but it regularly takes these huge, severe drops. It looks like a staircase falling off a cliff sometimes. Yeah. And these dips, they represent the massive floating losses the system is racking up. That's the danger zone. Because when those floating losses get too big, they trigger a margin call from your broker, and poof, the entire account is liquidated. Just like that. One sudden catastrophic event.
It's really fascinating when you put it like that. The balance line is like the perfect Instagram photo.
Yeah, good analogy.
But the equity line is the actual bank statement showing how close you are to total ruin. So when you hear that phrase, and it comes up a lot, when people try to sell you this type of expert advisor, they usually show you the balance. What they don't show you is the equity. You have to understand that omission is the entire business model.
It's the whole game. It's an illusion. Because if they showed you the equity curve, you'd immediately see the massive inherent risk, the unavoidable risk, really.
Okay, that brings us neatly to the second massive trick. How do these vendors always seem to have a perfect account to show off? Even though we know, mathematically, these systems have to crash eventually. How do they hide all the failures?
Okay. This is where the data manipulation gets really interesting. They rely heavily on a concept known as survivorship bias.
Survivorship bias. Oops.
It's basically a statistical trick. It exploits probability to pretty much guarantee they always have a winning example to show potential customers.
That sounds like a fancy term for, cheating the system. Walk us through how it works. How does a vendor actually manufacture success from, dozens of failures?
Well, it starts by acknowledging they can't just run one big safe account. They know that account is doomed from the start eventually.
Right.
So instead, they run dozens of smaller accounts. The source suggested maybe, 20 to the 50, all with slightly different settings, different strategies, different currency pairs.
Okay.
And they run them secretly in the background for maybe 6 months, maybe a year, to build up some history, some credibility.
So it's not just one account being tested. It's like a massive hidden lab running 50 experiments at once.
Exactly that. They're generating dozens and dozens of potential histories.
Huh.
But inevitably, because of that underlying risk we just talked about,
Yeah.
most of those accounts, let's say 90%, maybe even 95%, they're going to crash. They'll blow up during that testing period.
And what happens to the accounts that crash? Do they just vanish?
Poof. They're simply deleted, wiped from the public record, wiped from the vendor's history. So the customer, you're only ever shown the one, maybe two accounts that survived,
Surely by chance.
purely due to random chance and happening to hit favorable market conditions during that specific window. And that single surviving account is then pushed forward, marketed as the proof that the strategy works 100% of the time.
That is. Wow, that's actually shocking. It reminds me of that famous story from World War II about the airplanes and the armor plating.
That's a perfect analogy for survivorship bias. Yeah, remind us of that one.
Sure. So during the war, engineers were studying the planes that came back from missions, right?
Mm-hmm.
And they noted where all the bullet holes were concentrated mostly on the wings, the fuselage.
Yeah.
So their first thought was, okay, let's put more armor where all the bullet holes are. Makes sense, right?
It's logical, yeah.
But this statistician, Abraham Wald, he pointed out the critical flaw. They were only looking at the planes that survived the flight.
Ah, right. What about the ones that didn't come back?
Exactly. The ones that didn't return were probably hit in the places where the surviving planes had no holes, like the engine or the cockpit, critical areas. So Wald argued they needed to put armor where the returning planes had no damage, because those were the hits that were actually fatal.
Okay, I see the connection.
These Grid Martingale vendors are doing the exact same thing. They're only showing us the planes, the accounts that survived the market volatility, maybe the lucky 5%, and they're completely hiding the 95% that got hit in the financial engine and crashed and burned.
That nails it. So the takeaway is they aren't selling you a stable, robust algorithm. They're selling you a lucky snapshot in time, a moment they know is highly unlikely to repeat for the next person who buys it. And this process, it's continuous. New accounts constantly replace the crashed ones in the background. It means the entire advertised track record is, well, statistically meaningless.
So if the odds are really that bad, we absolutely need to dive into the mechanics, the actual math that makes this strategy, such a guaranteed failure in the long run. Let's focus on that dangerous math now, this whole Grid Martingale idea, aiming to never lose. How does that exponential risk actually build up?
Okay, the core idea is actually quite simple on the surface. Never close a trade with a loss. That's the goal.
Right.
So when the market moves against your position, let's say you bought euros, the price starts dropping, the system doesn't cut the loss like a normal strategy might. Instead, it opens another trade in the exact same direction, so another buy.
Okay.
But, and this is crucial, with a significantly larger volume.
That's the martingale part, right? Borrowed from, casino betting strategies, high-risk stuff.
Precisely, yeah. If your first trade was, say, 0.01 lots, the second one might be doubled to 0.02, the third doubled again to 0.04, then 0.08, 0.16. It keeps doubling or at least increasing exponentially.
And this ladder of increasing trades is the grid they talk about.
That's the grid, yes.
Yeah.
This rapid exponential increase in volume.
Now, the magic, and I use air quotes there, the thing that makes this strategy so addictive is that because your total volume is ballooning so fast, you don't actually need the price to recover all the way back to your original entry point to get out with a profit, right?
Absolutely correct. That's the hook. Because those most recent trades are so massive compared to the earlier ones, you only need a very small price movement back in your favor, a tiny little retracement for the entire group of trades to hit an overall combined profit target. Maybe just a few cents or dollars.
Oh.
And when that tiny profit target is hit, bang! The entire group of trades gets closed, the balance ticks up slightly, and the cycle starts all over again. And, it works. Maybe 99 times out of 100. It feels invincible most of the time.
But that 100th time, that's the disaster waiting to happen. What's the fatal flaw in the math there?
The fatal flaw is just, well, it's market reality. It's a long, strong, one-way market move without a decent pullback or correction.
Like a big news event.
Exactly. Think of a surprise interest rate hike or some geopolitical crisis that causes a really sustained trend in one direction. Because your position volume is doubling or close to it with every single new trade added to that grid.
Yeah.
The floating loss just balloons exponentially. It grows incredibly fast. And the margin required by your broker to just keep those huge positions open explodes way past the equity you have left in the account.
And once that point is hit, there's no recovery time. The system doesn't get a chance to wait for that retracement. It just goes straight to a margin call from the broker and liquidation.
Total account liquidation. It's a mathematical certainty, really. It's not if, it's when. When will the market serve up that perfect storm condition that the grid can't handle?
It's the catastrophic outcome that's completely hidden by that smooth, beautiful balance curve, just lying in wait.
Exactly. Waiting for the right conditions.
Okay. So we've laid out the deception with balance versus equity, the statistical manipulation with survivorship bias, and the mathematical certainty of the crash. Given all of that, and thinking about how competitive and efficient the Forex market is now, plus the rise of, AI tools and easier algorithmic trading, is there any way to sort of tame this beast? Can you take the idea behind it but move from guaranteed catastrophe to something like controlled risk?
Yes, absolutely. Look, the underlying principle of automated trading itself is sound. It's the specific never lose philosophy of pure Grid Martingale that's the poison pill. The source material does suggest a safer approach is possible, but, and this is key, it requires radically changing that core Martingale idea. It really rests on two main pillars of control.
Okay, let's break those down. What's the first pillar?
Diversification is the first one. Instead of putting all your capital into one large centralized account, which is basically putting all your eggs in one very fragile basket.
Right, vulnerable to one bad market event.
Exactly. You spread your capital across multiple smaller accounts, and critically, these accounts should be running different strategies, maybe variations, different currency pairs, maybe even trading at different times of day.
So you're spreading the risk.
You're spreading the systemic risk across different market conditions. So if one account does hit that bad patch and crashes, it's a controlled loss within your portfolio. It's not a total wipeout of all your trading capital.
Okay, that makes sense. Diversify the risk. And the second pillar, you said this was maybe the most crucial.
It is the most crucial. It's the total philosophical shift away from never lose. It's about implementing a fixed stop loss.
The stop loss. Okay.
Yeah. This is the absolute non-negotiable change you have to make. Instead of just letting the system run wild until the market inevitably forces a margin call and liquidates the account when it hits zero, you preset a maximum acceptable loss level.
So you decide beforehand.
You decide beforehand, okay, for this particular strategy running on this account, I am not willing to risk more than, say, $1,000 or maybe 10% of the account, whatever your risk parameter is for that specific grid or strategy instance.
And how do you arrive at that number? Is it just plucking a figure out of the air, a psychological boundary?
No, it shouldn't be random at all. That $1,000 or that 10% loss, it needs to be determined based on pre-rigorous backtesting and your overall risk management plan. Use tools, simulate how the strategy performed over historical data, including the losing periods, and you figure out, okay, how often can I realistically expect to hit this stop loss? And what kind of profit target do I need when it doesn't hit the stop loss to make the whole thing worthwhile? By fixing that maximum loss point, you're essentially building yourself an emergency exit ramp before the cliff edge.
That completely changes the game, doesn't it? You're no longer just gambling that the huge floating loss will eventually somehow recover before you blow up.
Exactly. You are transforming what was a potential catastrophic loss, that inevitable account blow up, into a controlled, predictable, and crucially manageable cost of doing business. You start accepting small, predictable losses as just the price of admission, the cost required to avoid guaranteed total ruin down the line. This shift, this move from hoping things turn around to actively managing inevitable risk.
Right.
That's the difference between a gambler and a professional algorithmic trader.
And the source material specifically mentioned using custom strategy software like Strategy Quant X. Why is having that direct control over the trading logic itself so important when you're trying to implement these safety changes?
Oh, it's vital, because you simply cannot implement these kinds of nuanced risk controls. The fixed dollar stop loss, maybe dynamic lot sizing adjustments, specific timing rules if you're just using some vendor's mysterious black box system where you have no idea what's truly going on under the hood.
You can't tweak what you can't see.
Precisely. Using your own tools, or tools that give you full transparency, ensures you have complete control over every single parameter. You can backtest exactly what happens after a stop loss is hit. Does the strategy wait? Does it re-enter? You can refine it, redeploy it intelligently, instead of just watching an uncontrollable system crash and burn, leaving you back at square one.
Okay, that feels like the ultimate takeaway here, tying all these different threads together. The promise of, risk-free, perfect profit from these Grid Martingale systems. It's purely an illusion. It's masked by deceptive metrics, focusing on balance, hiding equity, and marketing tricks like survivorship bias. And fundamentally, the system's math is designed to fail, eventually.
So what does this all really mean for you, the listener, trying to navigate this space?
Well, knowledge, as always, is your absolute best defense against these marketing illusions. The key is really understanding that trying to achieve never lose in trading actually guarantees eventual catastrophe. Real success in algorithmic trading, even if you're using potentially high-risk strategies like grids, requires accepting controlled, predictable risk. And that comes via transparency and usually a fixed stop loss. You essentially trade the illusion of perfection for actual stability and control.
A necessary shift, it sounds like, from blind optimism to some hard-nosed realism.
Absolutely. At the end of the day, trading is the management of risk, not the complete avoidance of it. That's impossible. Right. Well said. And for you, our listener, here's maybe a final provocative thought to mull over as you process all these truths. Given the increasing competition we see in the markets now, especially from more accessible algorithmic tools, everything from independent coders to quite sophisticated AI, what specific market inefficiency or perhaps what unique proprietary data source do you think will be required for any automated strategy, grid or otherwise, to generate truly reliable long-term profit in the future? Is the edge purely in speed now, or is it about having information nobody else has? Something to think about. We'll leave you with that.